So it's all over the news, friends. Inflation is high. It's going higher. 9%, 15%, whatever you want to call it, it's high. Now, what is the Federal Reserve going to do, right? I am making the case that the Fed is going to actually lower rates and not continue to raise interest rates when we come into December. And I have a couple specific reasons I strongly believe that's going to happen. You have to stick around at the end to find out fully. But it is a mess. The Fed is not sure what to do. This is a contrarian share. I'm going to go over it in 3 easy steps. I think you're going to get some value out of it, but stick around for the quote at the end. Let's jump right into it. All right, if you haven't downloaded my new ebook, which is called How to Use Inflation to Your Advantage, it's a book, it's about 50 pages of just data, information about how you can actually use inflation and not be a slave to it. You can actually use it to help you. So check down in the comments below, or in the description below, there's a link there that you can download that book for free. So check that out. A little disclaimer, I'm not your investment advisor. Get your own financial advice. These are just my opinions. But I am strongly convinced that rates will go down again by December. The Fed will drop the Fed funds rate down. Now, why do I think this, right? Because everything is saying rates are going to go up, right? They've raised rates. They started raising rates in March. So they waited a long time, probably too long. They've even come out and said, we probably waited too long to raise these rates. But in March, they're going to start raising rates, they started raising rates. And the average historically is that rates go up for a period of about 2 years. That's the historical average. If you look through history, once the Fed starts raising rates, on average it's about 2 years. The longest they've done it is 3 years, right? So they're already on the clock to where, and then at that point, whenever things stop going up, they start actually lowering rates. So it typically is not a super long time. I think it's going to be even sooner. Daniel DiMartino Booth says we're in recession now. I believe it. I think a lot of people are seeing that we are in recession as rates are rising. So my opinion is this, is that something is going to break in the financial system, meaning there's a group, maybe it's airlines, maybe it's manufacturing, maybe it's finance, and some group is not going to be able to get debt that really needs debt, and it's going to cause a break in the financial system, and they're going to have to reverse course. And that's one reason I think it's inevitable, right? Is that if, let's say, a manufacturing as a whole, they rely on short-term interest rates, or they rely on being able to get goods, and all of a sudden just, the financial system is super, super complex. If there's one thing you need to know about the financial system, it is very complex. There's lots and lots of different moving parts, and it's hard to predict what is going to happen. So when you dramatically raise rates, we've effectively doubled the interest rate on a lot of things just very recently, and so those costs are going to start showing up everywhere. So I think it's going to, somewhere it's going to break. I work in real estate and multifamily. I don't think it's going to be multifamily or in real estate. I think it's going to be some other industry is going to break, and they're going to have to start to reverse course. There's also another reason why I think that this is inevitable. And really what it is that the midterm elections are coming up in November. Now, people are talking about a red wave coming in. Biden has the lowest approval rating of any president. And if you look at what happened with Jimmy Carter, really a lot of it was inflation was sky high. People, and even when Ronald Reagan says, are you better off than you were 4 years ago? Right? And the answer, of course, was no, because inflation was high. There was a lot of pain. People were paying more at the pump. I actually have an electric car, but a lot of people paying $7 a gallon at the pump, at least in California. So politicians know this. This is the pain index, right? People are getting there's so much pain happening to them at the pump, with rent, with all kinds of things, and people are sick of it. So politicians know this. So at some point, they're going to have to reverse course. Now, the Fed has said, and historically, we're an independent organization. We're independent of politics, but it's not true, because they comment on their policies. You'll see the president's administration just throughout the year, especially the last 5-10 years, comment about the Fed, what they should do, what they shouldn't do, and it's not independent. And so they are swayed. And so sometimes the Fed will want to throw a bone to politicians to help keep them going. So I think that at some point they're going to have to lower the Fed's fund rate. Now, the thing that really is interesting in all this is that these costs are actually, rising costs are actually caused by all of this stimulus and all this money printing that the Fed and the Treasury and all these, the politicians have done. They've put all this new money in there. It was 40.9% new currency, physical or digital, over a 2-year period between February of 2020 and February of 2022. And I've talked about that on other videos, right? It's just this massive, never before seen infusion of cash. And that's why we're having inflation. Milton Friedman says that inflation is anywhere and everywhere. It's a monetary phenomenon, right? So if you increase the monetary supply, you're going to have monetary inflation. And that's exactly what we're seeing. So the Fed, again, like I said, they're supposed to be independent. They're going to drop rates. If you see this chart, my friend Brian London, who runs the New Orleans Investment Conference, if you haven't been to his conference, it's amazing. It's just a great conference. Lots of amazing people there talking about economics and natural resources and real estate. And so he has this chart here, and he said, if you look at the trend of the last 15 years, look at where rates have been going, right? Rates have been going trending negative. See the red line there? Every single time there's a recession, every single time there's trouble, they lower rates. I actually believe there will come a point in the very near future that rates may actually go negative. And you might think that I'm absolutely crazy, but look at the trend line, right? Where is the natural next spot for it to go? It's already happened in Europe, and it could absolutely happen here. So when you say, Bronson, well, what about inflation? And I'd say, I think what's going to happen is they're going to see a real struggling economy, and they're just trying to get life support out to do anything they can to be able to support it. So I'm going to give you some action steps in this next part here. All right, so the third step is, what should you do, right? What are the things that you should do with this information if the Fed's going to actually lower rates? Well, the thing I would say is that don't fear not, but take action now. There's a window of opportunity here that if you take action, you actually, again, can use this to your advantage. We talked about 40.9% new currency in the system. Basically, debt is still really cheap compared to inflation. With all the new money, it's important to look at to see that inflation is here to stay. And again, I'm not a fan of the Federal Reserve. I think there's a big movement now to end the Fed, which I think would be amazing. But it was created in 1913. 150 years prior to that, we had no inflation. There was literally very little or no inflation. Things would go up and down, but we generally had no inflation. And in 1913, when the Fed was created, since that point, so just over 100 years, we've had a 98% loss in the purchasing power of the dollar. So the plan is just to continue to do more debt, more debt, more debt, more debt. So what I would say to you is you can take advantage of it. You can take advantage of the debt, you can take advantage of the easy money, and you can use it to actually grow your wealth. So don't resist it, don't hold cash, ride the wave. And in this ebook, I keep mentioning you need to download it, you need to share it with a friend, because it talks about 3 different ways specifically that you can use it to your advantage. You can use debt, you can buy real assets that cash flow and pay you to hold them. There's also a case for precious metals. You can see my precious metal, you can't really see it, here's my precious metals right here. So you can use precious metals, and you can get out of fiat. This is a $100 trillion bill from Zimbabwe, where they just printed literally the largest bill that they ever had in 2008. So I hope this encourages you. I want to share a quote for you that it really talks about what the Federal Reserve is. And it says, the job of the Federal Reserve is to take away the punch bowl when the party is getting good. Well, you see, they didn't really take the punch bowl away this last time, right? And that's why we're having sky-high inflation, and that's why they've even admitted saying it's been too long. So check out this video I also did about high inflation investing. If you're storing cash right now, if you just have cash on the sidelines, I really encourage you to watch that video. I think holding cash is a big mistake. That's my opinion. So anyway, hope you enjoyed this video. Download the ebook below. We'll look forward to seeing you on the next video. Stick in the comments. Do you think the Fed is going to lower rates by December? Do you think I'm out of my mind? I'd love to see that down in the comments.